Well, if you looked at the syllabus, you know that we are on to our last 4 chapters of this semester. This one is on equity, and we also have earnings per share, and we have a compensation chapter to cover. So these next few chapters are related to each other. And if you don't understand the concepts in chapter 18, just like all the other chapters, then it builds. And so we'll be into another chapter that builds upon this discussion on equity. I'll have 2 PowerPoint discussions, and the first one is going to cover our learning objectives 1 through 4. And then the second one will cover the remaining 2 learning objectives. Equity is often referred to as a residual, and I really think this is kind of a bad thing to do that, because if the theory were really great, then we would, when we discuss equity, we would be able to say what it is. You know, we can say that assets are things of value, they're things that we own, and they're positive things. We can say that liabilities tend to be negative things, and they're things that we owe to others, and we've discussed that. So why can't we refer to equity as something like that? And what we can say about equity, though, is that equity is the residual. It's what's left over. So we have assets, which are positive things. We have liabilities, which are negative things. And the net of those is called equity. And that's that simple accounting equation that you had to learn in Accounting 201. So another expression for net assets is equity. And on the CPA exam, they'll say net assets. They'll ask you about net assets. And someone will always say, well, that's accounts receivable minus the allowance. That would be net. And we say, no, it doesn't say net accounts receivable. It says net assets. And net assets means total assets minus total liabilities. And that is also equity. So our learning objectives for this chapter: the different accounts in stockholders' equity and how those accounts arise. And if you looked at the preceding discussion, which was in the module, you know we really have 2 classifications. We have contributed capital and we have earned capital. The contributed capital is really a gift, because people are investing in us and we are getting the funds coming in. We don't have to do anything. Now, if we want more funds to come in, of course, what we have to do is perform, and our performance is through earnings. The other is retained earnings, which is an accumulation of earnings for a company, and this is called earned capital. And oftentimes people put AOCI in there, but I say, is AOCI earnings? No, not really. The second learning objective is the different presentations of stockholders' equity. I'm not going to spend a lot of time on this because you should have had this in Accounting 201. Instead, our emphasis is going to be on the corporation and the corporate form of stockholders' equity. Third is issuance of shares. You should have had issuance of shares for cash. Now we're going to talk about non-cash. And then the fourth is treasury stock transactions. Treasury stock is when a company buys back their shares of stock that are outstanding. Students get confused here, and they often say, well, that's a debit to investments. No, investments is investing in another corporation stock. This is our own stock, and you can't invest in yourself. Why would you use equity versus debt? Well, this goes back to our discussion about the contribution. When you have equity, you are having funds coming in that you never have to pay back. And you also don't have to pay interest. Now, when I say you never have to pay back, the assumption is that the corporation will not go bankrupt, will not dissolve. If it dissolves, then it's possible that you'll have to pay back. But if you pay back in a certain order. That is to say, your debtors would be paid first, your preferred stockholders would be paid first, and then the common stockholders would be paid last. So in general, you don't have to pay back that amount that's been invested. You get to keep it. It's a contribution. It's a gift is the way I look at it. And so that's why it's called contributed capital. And you don't have to pay interest. Now, if you have preferred stock, sometimes a preferred stock will have a caption which says a percent on it, which means you're going to pay something that looks very much like interest, but you only have to pay it if dividends are declared. If dividends are not declared, you do not have to pay. Corporations issue stock, common, preferred stock, and sometimes corporations have different levels of stock, and these are called classes. And the different class designation means some shares will not have voting rights and some shares will have voting rights. Issue stock, corporations also accumulate earnings that goes into retained earnings. They can buy back their stock, they can pay dividends, and they also pay taxes. Partnerships have capital accounts for the partners. They are owners, and the owners are allocated a part of the net income or earnings. And then distributions are made to the owners, which also affect the capital accounts. Partnerships do not have unlimited life. Corporations have unlimited life. However, partnerships will be dissolved if there's an incapacity of any of the owners. So if an owner is to die, of course, this is an incapacity, but also the inability to function would be considered an incapacity. It means a partnership gets dissolved. So a corporation is considered to have a very long life, and partnerships, on the other hand, have shorter lives. Sole proprietorships, like partnerships, will bear significant legal risks. In a corporation, the legal risk is shielded as to the investors. If you invest in a corporation and the corporation does something it shouldn't do, and there's a lawsuit, you may suffer some consequences in that stock price might be affected, so your investment's value may go down, but you aren't going to be sued. You're not going to have to pay anything in that lawsuit. However, in sole proprietorships and partnerships, if there's lawsuits, then it's possible that the assets of the investors will be attacked, and we call this attachment. So the personal assets of the owners can be attached, and you could lose your assets if you're an investor. So one of the other alternatives here that's somewhere in between a corporation and a partnership or a sole proprietorship is an LLC. And a cost to establish an LLC varies. If you go to a law firm and have it done, it could be $2,000. But you could consider that as some sort of insurance, because then in the case of a lawsuit, you're protected. Here is an example, and I see that in what you're seeing, I cut off the top part of the balance sheet. It's the name of the corporation. It says it's a balance sheet, and the date is what you can see. It says December 31st, 2016. And for brevity's sake, we have eliminated the details of the assets or the liabilities, and we're just giving you the net assets of the shareholders' equity. So 3 minus 1 is 2,000, and this is in millions. So we'd have to add some zeros to that, 6 zeros to be precise. And that is the net assets, which is also shareholders' equity. You notice here they call the caption paid in capital. I would say this is contributed capital, not to be confused with the paid in capital accounts here. So the total of contributed capital includes the preferred stock, the common stock. This common stock dividends distributable means that they have dividends in the form of stock that are going to be distributed that have not yet been distributed. When these stock dividends are distributed, there will be more shares of stock. And so it's just a timing issue there. The paid-in capital in excess of par for preferred is the amount above par value, that is market minus par, times the number of shares issued. And this is for preferred. The same calculation is done for common, and that's there. Paid-in capital share repurchase. When you see repurchase, what we are talking about is treasury stock transactions. We'll discuss those. Paid-in capital conversion of bonds. What does that mean? Well, in a previous chapter, we talked about bonds that were convertible into stock, and we said you normally will record the bonds even if they have a conversion feature as if they didn't have it. And then at a later date, you decide or the investor decides to convert those bonds into stock. You'll handle it when you do your journal entries. So this paid-in capital from conversion of bonds is really a product of that journal entry that removed the bonds and established the stock. Paid-in capital stock options and restricted stock, these two are as a result of issuing stock options. And one is from, the first one is from stock options. The second one is from issuing restricted stock. I meant to say both of these are as a result of compensation given to our employees or our board of directors. Paid-in capital lapse of stock options means the stock options were out there, they were not exercised, and when these stock options, which were formerly, say, up in this account, are let to lapse or not acted upon within the time period where the option can be used, then we transfer the balance from paid-in capital stock options to this account paid-in capital lapse of stock options. So they have a total here for paid-in capital. I would say this is a total for contributed capital. Then we have retained earnings. Retained earnings is always the beginning amount starting at 0 when the company or the corporation begins. It increases by the amount of earnings for the company, and it goes down by dividends. Dividends do not have to be cash dividends. They can be other dividends, but those are the negatives that reduce retained earnings. AOCI, Accumulated Other Comprehensive Income. I'm sure that you remember the first one, and this comes about, and you studied this in Intermediate 1. Intermediate 2, we have just covered discussion about pension and gains and losses in pension, and if you recall, we used the corridor method when we thought we were putting too much into this account. Deferred gains and losses on derivatives. Derivatives are discussed in your next class, which is advanced accounting. And also, I'm hopeful, I'm not quite sure if you cover it or not, but foreign currency adjustment rates. What are these things? Well, foreign currency rates adjustments come about because the financial statements of a conglomerate are done in different currencies. So you might have a balance sheet for one company that's in the U.S. done in dollars. You might have another company that has their balance sheet done in euros. Somehow you have to come up with one financial statement, which is a consolidated financial statement, which brings together those two companies, even though their currencies are different. And this is the adjustment which is needed so that you can have that one consolidated balance sheet and income statement for the company. Treasury stock, what I want you to see here is that it is negative, which means it has a debit balance. Treasury stock will either have a debit balance or it will have no balance at all. And the other thing is treasury stock is being accounted for at cost. So it's being accounted for at cost. That's the method at which they are recording treasury stock. When you looked up here above at AOCI, you notice this balance here is also a negative, or it has a debit balance. That means for this particular company, the losses in AOCI are greater than the gains. That's all it means. And AOCI can have gains, it can have losses. There's not a general rule which says I should have a credit balance or I should have a debit balance in that, because these are not really the effects of earnings. Now, retained earnings should either have a zero balance or it should have a credit balance, which shows up as a positive here. Paid in capital should always be a positive number. So these are the kind of the rules you have as far as the debit and credit balances that you will see in shareholders' equity. I would not expect to ever see a negative balance in these additional paid-in capital accounts. You just don't see it. In fact, some of our rules with our journal entries say if it causes you to ever have a negative balance in here, you will take the remainder out of retained earnings, so to avoid having negative balances in these accounts. So these will have credit balances, these will have credit balances, therefore total paid in capital will be a credit. Retained earnings will either be credit or zero balance. AOCI, it can be credit, it can be debit. Treasury stock is either going to be at zero or it's going to be a debit balance. And then you're back to the double underlining, which means the assets minus the liabilities equal equity, or as I always say, damn, I'm good, my balance sheet's in order, right? So common stock is the most likely type of stock that's issued by a company. And when you see that dollar value out there, it is par times the number of shares issued. I'll have some more discussion of issued versus outstanding coming up. Generally, once you issue a stock, you issue a stock. It doesn't stop being issued. The only time it would stop being issued is if you were to retire stock, and companies generally do not retire stock. So very few journal entries on that. Preferred shareholders, they often, as we discussed before, there's a preference in dividend payment, and cumulative preferred stock will pay dividends in arrears if they haven't paid it. Preferred stock also has par, which means it's par times the number of shares issued, and that's what the dollar value is. Paid in capital generally is from preferred or common shares issued, but there's other things that show up, and we had a few of those. Retained earnings we discussed, treasury stock we discussed, and AOCI I've also discussed, so I will not go through those again. This is issued versus outstanding, very important concept. If you read the introduction to this module, there's a discussion with an example there. Here's another example of that. Seems to be a difficult concept for students to understand. Issued means that the shares have been issued, and outstanding means that someone or a company outside our corporation owns the shares. They're outside of our company. So they are in the market. Mary Corporation issued 100,000 shares of $10 par value stock for $20. If I were to ask you what is common stock in dollars after this transaction, you would say 100,000 times 10, right? That's the total common stock value that would show up on the balance sheet. Now, after that, Mary is going to buy back 10,000 shares of stock. Well, I'd say, well, what is common stock after they buy back the shares of stock? It's going to be the same because it's issued times par. So 100,000 times $10 par is what you're going to see as common stock, even after the treasury stock has been bought back. The issued number of shares is still 100,000. So the common stock account is going to still have 100,000 times 10, which is a million. Now, the outstanding shares, though, when you do your caption, your outstanding shares is not going to be 100,000. It is going to be 90,000 because 10,000 have been taken off the market, retained by the company, and held in the treasury. So sometimes it's helpful to think of the treasury as a box. It's a treasury box, and you're putting the shares in it. So if you put 10,000 away and you had 100,000 out there and you took 10,000 out of it, the amount that's out there in the market is now 90,000. You could also refer to this terminology with preferred shares, but usually preferred shares aren't purchased. One of the reasons why you buy back treasury shares is to affect stock price. If you buy back shares of stock, there's fewer shares of stock in the market, so the value per share would go up. Mary Corporation issued 100,000 shares of $10 par at a selling price of $20 and had issuance cost of $5,000. How do you record this transaction? Well, when you record this transaction, one of the first things you need to do is, what's my net cash that's going to come in? Well, it's 20 times 100,000, which would be 2 million. And then you're going to take out of that. Usually what happens is the amount of cash that you get in, the influx of cash is going to be a net amount. And you get the net, which is minus the 5,000, or $1,995,000. The common stock, again, is always par times issued. Therefore, it's a million. And then the paid in capital account, and I could have had after this common stock, will be 995,000. You could think of this as a plug number, but you could also do the calculation, and you could say it's the difference between market price minus par times the number of shares issued minus the 5,000. This 5,000 takes a direct hit to equity. In other words, it immediately reduces the equity from that stock offering. The cash coming in is not 2 million. The cash coming in is 5,000 less, and it comes out of paid in capital common stock. The contrast to these is if you had a debt offering. If you had a debt offering, say in bonds, what we said we did with issue cost there is if the bonds were issued with the premium, we reduced the premium. If the bonds were issued at a discount, then we increased the discount. And if the bonds were issued at par, we recorded a discount equal to the amount of the debt cost, the cost of issuing the debt. So when we put it in and we recorded it for our bonds, we were amortizing it, and we were amortizing over the life of the bond. Since common stock usually doesn't have a life because the corporation is going to continue for, I guess, infinity generally, we don't have a period of time in which we could amortize that off. Therefore, we take it directly to equity. In the other instance, we take it to equity with debt. We take it to equity in a sense because we are hitting interest expense, and interest expense flows through what? Retained earnings, which is an equity account. So it's amortized in debt, and yes, it hits equity. It hits equity a little bit at a time over the period of time in which the debt exists. In this case, it goes directly. This is a concept which has to do with the theory of accounting. Now, some people say they don't like this. They say, what should it matter? Whether they're issuing stock or whether they're issuing bonds, shouldn't it hit the income statement in the same way? Why should it matter? So there's a theoretical discussion about the different ways in which these issue costs are handled. Now, what happens if you were to issue the stock of your company and instead of the individual, the investor giving you cash, they gave you something else? Now, in this example, I say an automobile. That's typically not done for a large corporation. Do you think a large corporation would consider issuing common stock for someone's automobile, even the most expensive automobile you could think of? And the answer is no. Generally, what we're talking about maybe is someone that says, "Look, I have this land out here, and you could build a plant on this land. Maybe you would give me stock for this land. I would like to have stock in your company for the land. I would actually prefer that to cash." So they want stock. Well, how do you handle the transaction? Well, whenever you have a swap, if it's an asset swap or putting an asset on the books for equity or putting an asset on the books for a liability, what you need to do is figure out which of the things can you value better. Which of the things do you have a established value for, or do you really trust the value of one over the other? In this example I'm giving you, you have an automobile. Now, the market for automobiles, there's Kelly's Blue Book, and you can go to that, but that particular automobile is not traded much, right? And on the other hand, you have a common stock of the company. If the common stock of the company is traded, say it's on Amex, New York Stock Exchange, NASDAQ, you know you have a value for it. And if you have a value for it, then you use that value to establish the value of the automobile. Now, on the other hand, in my second paragraph up here, I say, what happens if Mary Corporation has stock that's just never traded? You know, the last trade was 2 years ago. Well, the automobile is probably traded more frequently than 2 years, so let's take the value of the automobile. In which case, you're going to record the common stock based on the number of shares times par, and paid in capital will be any difference which you need to use to plug in. So the number which you have recorded then will be this number. This number is par times the number of shares, and this number really becomes a plug. When stock is issued in exchange for property, the best evidence of fair value might be what? Well, I do like the price of stock quoted on a stock exchange. I do like the selling price of stock in a recent transaction, assuming it's being, there are recent transactions. The appraised value of the property, I said that's okay. If you have a better market for that than the stock, you should use it. So I guess that gets us down to the one that doesn't seem to make sense, and that's the book value of outstanding stock. Now, book value of outstanding stock, I really don't know what they're talking about when they even use those terms. But book value is not relevant in this transaction. And here is a description of what we were discussing. It says, which seems more clearly evident. When you have more than one security issued at a single price, this happens at times, not too frequently, but it can happen. And my example is having common stock and preferred stock issued in a single transaction. What do you do? Well, if you have a market for both of those, you would allocate according to the fair value of both of those, common stock and preferred stock. So you go out and look at the market value, assuming they're both being traded, and then you would allocate. It's similar to what you would do if you have land and a building bought together. You go out and look at fair values and you allocate. Another way to handle it, though, is if you have one security's value known and you don't know the other, then you can consider the residual, or what's left over from the total amount, is going to the one which you do not know the selling price of, or you do not know the market price. So you can go to the textbook and you can find an example of that. Repurchases of stock by a corporation are interesting concepts, because this is when a corporation goes out there and purchase back their own stock. Why would they do it? Why would you want to do such a thing? Well, you do it because you want to have it available, say, for distribution to employees. Say you have a plan where employees can buy stock of your company and they can invest in the company as a payroll deduction, and you are, as a corporation, are going to do something good for the employees and not make them pay commissions on the purchase. So what you'll do is you'll go out, and before the end of a month or end of a payroll period, you'll go out there and have the stock, and you'll buy it and you'll have it in your treasury, and then you'll take it out of the treasury and send it out to your employees according to what their payroll deduction was. You can also do it because you don't want other companies or individuals buying up so much stock that they can take control of the company away from the current structure of that corporation. You want to consolidate the equity. Maybe you're a conglomerate, have various different companies, or you want to manipulate stock price, because if you have fewer shares out there, then you will have a higher stock price. That's sometimes a good thing. Corporations could either retire the stock or they could put it in the treasury. If you retire stock, you're basically doing a journal entry that's the opposite of when it was issued. So I'm not going to have you do the journal entry, but you would think about it this way. You are crediting cash, you are debiting common stock, and you're debiting paid in capital common stock. And you will do those debits for the same amount as you originally credited when you issued the stock. So as I said before, I'm not asking you to do that journal entry, but that's what a retirement does. So when you retire, it's like a reverse issue. Okay, it's reversing out an issue. And as I said before, generally when you issue stock, it's issued. It's outstanding, it's issued. The only way you can impact an outstanding is usually by putting it in the treasury, not by reverse issuing or retiring. When you put it in the treasury, it's put into an account called treasury stock, and as you see here, 10 shares of $10 par for $20 per share. If it's done according to the cost method, then you're going to take 10 times 20, and you're going to put 200 in treasury stock. Shows up as a debit. It's debited. It can be credited. It can never be credited for more than the 200, because if it were credited for more than 200, then you would have a credit balance in treasury. You cannot have a credit balance. So either you have a zero balance in treasury or you have a debit balance. You create the debit balance by this journal entry that is debiting treasury stock for that purchase. Okay, it's called treasury stock. It's not called investments, and you are debiting it. And you're debiting it here under a method which is a cost method. If it were the par method, you would be debiting treasury stock for par times the number of shares. The one that's most commonly done is this one, which is based on cost. Now, we have those 200 shares in there. We have them put in there, and we show a debit balance in treasury stock. If all of those shares, all of the 10 shares, were later, we call it reissued, but again, it's not a new issuance. Once it's issued, it's issued. What we are doing here is we're taking what we had in our treasury box and we're putting out there in the public, and we're going to make it outstanding again. So the 10 shares which we took in and took out of the outstanding, put in our treasury, we're going to now issue them back out to the public. We're going to send them back out to the public. When we do this, in effect, we are selling our stock that we have been holding, and we are going to get cash in. So the cash we have coming in here, if we reissue or send back those out at $15 a share, is going to be $150. Some of you astute persons are going to say, but we just paid cash of $200 for it, and now we are sending it back and we are only getting $150. So we have a loss situation. I'm going to say, you're right. You're right. In terms of cash flow, it's a loss to us. But we do not call it a loss. We can't call it a loss because we cannot trade in our own stock. So instead, we are going to call it paid in capital treasury stock and call it a debit and put a debit in there for 50. The cash again that we're paying is 15 times 10 or 150. We are going to be forced to credit treasury stock for 200 because that's what we put it in at. You can't take it out for more than you put it in at. You have to take it out for exactly what you put it in there for. Now, if we do not have, here we're going back to our debit and credit rules about equity. If we did not have a credit balance of 50 in the paid in capital treasury stock account, and we did this 50 debit, it would make our paid in capital treasury stock have a debit balance. We can't do that. So if that's the case, we are going to use up our paid in capital treasury stock to the extent which we have a credit balance in that account, and the remainder would go to retained earnings. Under B, we're a little wiser in B because now of the $200 that we paid, we are now sending it out and getting $250. Okay, so 250 is the better transaction, really, in terms of cash flow. We still cannot call it a gain. In this transaction, we are going to call it paid in capital treasury stock. This time, we don't really have to worry about what our balance is in the paid in capital treasury stock because we're doing a credit. We are increasing the balance. The point in A was we cannot decrease the balance in paid in capital treasury stock to the point at which we would have a negative balance in it or a debit balance. In the second one, we're crediting. So that won't cause us to have a debit balance. It's a credit. Now this caption, let's go back to the caption a bit. It says paid in capital treasury stock. Another thing which you often see is paid in capital stock repurchase. It's identical. It's the same thing. Why do we use so many different terms and why aren't we consistent? I can't really answer that question. As I said before, sometimes when we look at the balance sheet, it will say paid in capital, and when they're saying paid in capital, they mean a group of accounts that is really contributed capital. So the terminology does get to be a little tricky. I always think of it as paid in capital, and I tend to not use the paid in capital when I'm talking about a group of accounts That I would say is contributed capital. Broyles reacquired 3,000 shares of its common stock at $55 per share. And the next year, they issue 1,000 shares at $75 per share. Gonna mention right now, the assumption here is that they only have one batch of shares in their treasury, because you need to come up with a convention for handling it, and it would be something like what you do with inventory. You can use weighted averages, or you can use LIFO sort of things, a convention for handling treasury stock transactions if you have different batches. And I think in our packet we have an example of that, so I won't get into it too much here. I'd say that with this problem, the assumption is that Broyles only has one group of shares in their treasury. And this is the 3,000 that they acquired in 2015 at $55 per share. In 2016, they're going to take 1,000 of those shares, 1,000 of the 3,000, so they're going to have 2,000 that's going to remain in the treasury, and they're going to send 1,000 out there, so it'll be outstanding, at $75 per share. And you're going to look at this and you're going to say, well, that's a pretty good transaction as far as cash flow, because they purchased at 55, and the cash that they're going to have coming in is going to be $20 more per share. I like that. Wouldn't you like that? We can't call it a gain though, right? So what would be included in this entry? Well, when they reissue, and again, it's not really reissuing, it's just taking out of the treasury, they are going to obviously get $75,000 in cash coming in, right? And this bottom one says they're going to credit cash for $75,000. They are not going to credit cash because they're going to get the cash in. It's going to be a cash debit. And then I'm just going to go through and say what you should do is just look at the journal entries here. The first one in 2015 is 55 times 3,000, and you put it in at 165. You can handle this a number of different ways. You could say, well, we need to get rid of a third of this total amount, because of the 3,000 we are going to have 1,000 going back out. You could also do it on a per share basis and say, I need to take out 1,000 times 55, which is a 55,000, right? And so you need to take 55,000 out of that treasury stock. So at the end, you should have what? You should have 2,000 times 55 in treasury, which is the 165 minus the 55, or 110,000, right? The paid in capital share repurchase, since this, we can't call it a gain, but in terms of cash, it would be a credit as if it were a gain, right? You don't have to worry about the balance that's in the paid in capital account. You're going to increase this by 2,000. It says paid in capital share repurchase. It could have said paid in capital treasury stock transactions. And again, the debit is 75,000. Always when you see something like this, you can go through it and you can look at each one of them and say, is that right? Is that wrong? Whatever. The easiest way to approach this is to say, what is my 2016 entry? The explanation in this PowerPoint was very nice. I got this from the publisher. They were nice enough to give us the 2015 journal entry so we could see it. If I had a marker board in front of me, I would do a T account, and I would say, initially in 2015, we have a debit left side T account of 165. What do we want to have remaining in that treasury stock debit? And we would want to have what? We would want to have 2,000 times 55, or 110,000 to accomplish that. Credit for 55. I just love accounting because there's so many different ways you can explain things. And that's what makes the theory rich in accounting. The next concepts we're going to cover are going to be dividends. So I'm going to leave this one